call them, and you'll hear a lot of times that their attorneys and the mortgage bankers will be like, hey, we're here waiting to hear back on title regarding something. And you can then call me directly, and I can go and expedite whatever it is, put it on top of the pile, and make sure that we get it done for you guys quicker. So a little breakdown on what title insurance is. I always tell everyone to simplify it. Take out the word title and swap in due diligence. It's essentially due diligence insurance. And then what I mean by that is when you buy a home, right, the title insurance is a premium that you pay, your buyers pay. It's a one-time payment that they make at closing. And that's to protect them, right, from anything that happens from the day of their purchase and the past. People think of homeowners insurance, right? And they think of insurance. And those are things that normally, like say the Allstate, Geico, State Farms of the world, right? That protects you from the day that your buyer buys the property and the future, right? From flood, fire, burglary, things along those lines, right? Title insurance is protecting them from anything that may hinder their ownership rights from the day they buy and the past, right? So any open permits, violations, judgments, liens, an open water bill even, right? Things that were attached to the property and to the previous ownership. So what happens is in this process, which is sometimes backwards, and why it's important to have a good title insurance relationship is because title insurance takes time, money, and effort, right, from a company. And the process in which you guys are doing your sales are a little bit backwards. You may be on the seller side representing a seller for 6 months before you get an offer that your seller is willing to accept, right? Once you guys accept those offers, you engage attorneys, right? You introduce someone like Jamie to one of your buyers or your sellers. Then Jamie and the other attorneys negotiating contracts. Contracts then get signed. Once the contract is signed, that's when someone, let's say Jamie's representing the buyer, Jamie will order title from someone like me, being like, hey, Sean, please see the attached contract. Please order title for this property. And we get started along that process. But remember what I mentioned earlier, which is take out the word title and swap in due diligence, right? It's due diligence report that we're basically putting together for both the buyers and sellers attorneys to review to make sure that there's no issues that the buyer may be inheriting from the seller or the property. Right? So that process you've now done, you've represented your seller for 6 months, and then something may come up that has issues with title. It's not necessarily going to kill a deal. Like I mentioned, it's a very high 90s% of deals that'll close, but it could delay a deal. And the most important thing we have in our business and in our lives is our time, right? So we want to be more efficient with it. So a lot of times what I tell agents is, hey, shoot me over an email on a new listing you have. Let's get out ahead of it and see if there are any issues that may come up with title, regarding title, once you get into contract, right? Because like I said, the process is backwards. I even tell agents and teams that I work with, hey, shoot me an email prior to you going to a pitch. Maybe I can pull a title report for you, and you can go into that pitch with an extra piece of data. Let's say, hey, did you know you have a sidewalk violation on your, Upper West Side townhouse? We should get out ahead of it. And your sellers might be like, oh, wow, they went ahead, stepping, above and beyond to to do due diligence, and the other brokerage or the other agent didn't do that. And you may win the listing because of that, right? You may win an exclusive because of that. And it's not something agents deal with on a day-to-day basis. They don't deal with title insurance. They don't even hear about it until some of these things are coming up, like, oh, well, we need to clear, the open permits. And a lot of your clients that you work with as agents, they're not savvy real estate investors. They're first, second, maybe third, maybe fourth time home buyer if you're lucky, right? But a lot of them are lawyers, or they're teachers, or they're tech people, or they're actors. They're things outside of the world of real estate where they hear things like, oh, title issues. They're not sure what it is. They don't know what's going on, right? So you getting out ahead of these things can also, help you from having to deal with a lot of the hand-holding and bedside manner you need to have to be like, no, listen, this isn't a big deal. We cleared this out, and you're having to explain it down the road. So I always say, feel free to reach out to me. Jamie, maybe you can send my information. I'm here at your disposal. It's just the same thing as having a go-to, attorney that you work with, a go-to mortgage banker or two that you work with, right? We're here to help add value to your business. We want to make sure you guys are doing more sellers, more buyers, getting the deals done more efficiently, more quickly. So that's a big part of what we do, is adding that value in there. There's other things we do as well, right? We'd love to add value to you guys. Let's say your new listings or launches of projects. So we are like a mortgage. We are on the buy side in New York State. You pay the buyers pay the title insurance premium. It's a one-time payment that they make, but we're here to help you on your seller side of things too. We're here to help add value in any way we can. And just to give you an example of what the costs of title insurance are, just so you're aware, is the easy example I like to use in New York is a $1 million condo. The pricing differs from whether there is financing or not. So it's anywhere from 1/3 to 0.5%. So $1 million condo, all cash, you're looking at about 3,300, which is 1/3%. $1 million condo with traditional financing, meaning a 70 or 80% mortgage, you're looking at about 0.5%, so about $5,000. So these things are good to know also, because when your clients get an estimated closing bill, or they get their closing bill and they're like, oh, well, what are these fees? You can, what the amounts are. You can explain what title insurance is. And you can always call me if you have any questions, or you want me to speak with your clients as well. I'm happy to help.
Sean, is there anywhere that there's a list of, you're talking about where you said 33%?
Yes, 1/3%.
A third of a percent is basically what the title fee generally is?
That's if it's an all cash deal.
All cash for $1 million.
Yes, for $1 million. It's closer to 0.5% if it's $1 million deal with a 80% mortgage, let's say, which is about
okay. And does it go up greater, or it's always that same sort of percentage?
No, it's a great question. It's based off of the purchase price, right? So a $10 million deal with, in all cash is about 33,000 in title insurance premium.
So it's still about 1/3.
Yes, it's about 1/3. It doesn't it doesn't jump up
based on the price. You're not paying extra.
No, the rate stays the same, anywhere from 1/3 to 0.5% based off the purchase price.
I've never seen it actually said that it is 1/3, or is it just that when you add up all the things, it comes to about 1/3 of 1%?
No, the premium,
Right.
title insurance premium
is 1/3 of a percent.
Yes, it's almost exactly 1/3 of a percent.
Okay.
There are other ancillary fees, right? There are little search fees and et cetera that do add up on your title bill, but the premiums are determined by national underwriters. There are 4 or 5 major national underwriters across the entire country, and each state, they regulate the price of the insurance premium. So it doesn't matter whether you work with ABC Title or you work with my company, Empire National Title. The pricing is exactly the same. Each state has a different rate, right? So like, for example, Texas has the highest rate. New York is up there with some of the highest rates. But New Jersey's a little less. Florida is a little less. Some states are extremely less, like California is one of the lowest premium states in the entire country. So it does vary from state to state, but I'm assuming most people here on this Zoom are doing most of their business in New York, and New York's rate is about 1/3% to 0.5% for title insurance, depending on financing. And the reason for that is because if there is a bank involved, let's say it's Wells Fargo or Chase or Citi, et cetera, they require the buyers to pay for additional title insurance to cover their portion, right? They look at it as their equity in the property as well. So your title insurance premium goes up because of that.
And is that the same percentage?
Yes, same percentage.
But is it, because like, let's just say hypothetically the purchase price is $1 million, but the loan amount is 800,000. So is it still 1/3 of the 800, that 1% of 800,000?
No. So it varies on the loan amount. So it would be the estimate can be anywhere from a third to 0.5%. So let's say they're taking 50% financing. It'll look at, 4 basis, basically it'll be close to 0.004, right, percent versus a third of a percent or a 0.5%.
But does it go twice? In other words, are you paying, if you're paying, let's say on that, you're paying $33,000 on the deal, and I mean your insurance, but you're also getting a loan. And let's just say that's 80%. You're not paying a double of the 33, aren't you? Only, you know what I'm saying? Like,
No, you're paying a discounted additional portion.
Right. So do you know what the calculation is, what the formula is for that?
It would depend on the loan amount, right? So
Okay.
the loan amount is 80%. You're looking at about another, 0.001%.
But what determines that? I'm saying, like, how do they calculate that? What's it based on?
No, it's a set state
Oh,
regulated.
if it gets to this number, it's this percent. Okay, got it.
Sure.
Got it.
So if it's a $1 million condo with 80% financing, you're looking at a 0.5%. Should the financing go down, let's say it's $1 million condo with 500,000, you're looking at a $4,000 premium. It's based off of the purchase price and the loan amount. So it's really just a formula.
Okay. All right, fantastic. Does anyone have any questions for Sean before he leaves us? And we're going to have Jonathan Miller starting at 11 o'clock. But before Sean goes, anybody? Anything for Sean? All right. The other thing that I just wanted to raise a few points, Sean, if you have another minute just to touch on.
Sure.
The two very common, and by the way, you can type into the where it says two at the bottom of the chat, and just bring the carrot to everyone, and then you could put your information in there. In the chat, if you go into the chat at the bottom.
I'm just going to type in my
Yeah. So anyway, what I was going to say was the two things that I find really important and useful, and I would recommend to all brokers to always utilize your title relationship for in the context of your business is twofold. Number one, any building that was a new development in the last, even decade, I would say, you have to always be careful to make sure you have checked that the certificate of occupancy is current. It's not uncommon to have buildings that year after year after year, they're sitting with a temporary certificate of occupancy instead of a final. And the TCOs are only good for 90 days. So that's the kind of thing that, the title company can very quickly get you the answer on. And, once obviously, Sean works for a living just like we all do, but when he's working with people and the agents he's working with, it's certainly, I'm sure, his pleasure to, be able to help you out where he can. Like I said, even if he's not on the buy side of the deal, even if it's just to see, well, you have a seller and you want to make sure that the CO is all set. The other thing might be air rights. But go ahead, Sean.
No, Jamie, to jump into that, yes, that's exactly right. And Antonio Wolf here asked a question asking if there is a fee for a preliminary title check. As Jamie mentioned, of course, I'm here, running a business, but at the end of the day, our value add to you guys is to make sure you guys are, on top of everything in terms of title. So we will not charge you a fee for a preliminary title check. It's my pleasure to do these things to help you guys so that you guys are out ahead of any issues that may come up. Of course, down the line, how it works generally is when you do have your buyers and you introduce them to Jamie, that you just say, hey, Jamie, when the time comes, hey, we just got an accepted deal sheet. Hey, we just got an accepted offer. I'm sending you the deal sheet, Jamie. Joe and Jane Smith are going to be buying here. When the time comes, please order title from Sean. And you can, add my email. I sent my email there. But no, Antonio, to answer your question, there isn't a fee for a preliminary title check. I happily do these things complimentary for you, so that way you guys are out ahead of any issues that may come up. And it allows me to, add value to you guys. So I'm happy to do those complimentary. That's just an important thing to know is that that is how, we do, we are on the buy side. So how we do make our money is when you do order, when we work with Jamie on your buy side of deals, right? You refer
Or
Jamie.
any one of the attorneys you work with. There are many others. It's okay.
Yeah, and if there's other
I mean,
attorneys.
that's the reality. I mean, Sean, if you're going to help out sellers, it's not everybody on here refers me business, and that's okay. I would love them to still be able to have access to you.
Yeah, of course. Like some of you here on this Zoom work with other attorneys, as well, right? And the idea here is that most agents don't refer title insurance, and not even sure how to. In reality, there are attorneys have relationships with title companies that help add value to their business. Jamie and I work very closely together. But if you're working with another attorney and you're on the buy side and you get a deal sheet, you get an offer accepted for one of your buyers, and you're sending a deal sheet to that attorney. You just, when the time comes, you can add me to the email and just be like, hey, Mr. Attorney, Joe and Jane Smith got an accepted offer here. When the time comes to order title, please order title for Sean. He's been adding a lot of value to my business lately, or something along those lines.
The reality is that it is a relationship business because no one's really doing anything different. Obviously, there are times where a title company might have to make a judgment call on whether or not they're, different title companies might have different requirements. A title company might require, X dollars more than another company to bond if there's, let's say, a sidewalk lien. That's where there might be some flexibility, but at the end of the day, somebody is making money off of your client's order, the buyer's order. Somebody's getting paid. So it's either somebody that means nothing to you and doesn't help you in any way, or it's somebody that, is there for you when you have questions asked. That's all it's really about. But, either that pretty much sums that up, right?
Yeah, no, absolutely. And Jamie's right. So to Jamie's point, right, title insurance, like I mentioned earlier, is state regulated. So it's the same price no matter what title company you go to, right? So it's not like we're a mortgage bank where we're rate sensitive. It's not like we're saying, oh, that, my client wants to go with the best rate, so I'm going with Citizens over, Chase because Citizens rate is 0.25% better. Our rates are exactly the same. So it really makes us, separates us, is our ability to add value to you. So are we adding more value to you than the other title person that you might not even know of, right? So the chances are, yes, we are. And we do a lot of other things too. We have a separate media and marketing arm. Most of you here are working for different brokerages, I'm sure, and each brokerage will determine your marketing budget on a few different types of things. Like one of the things that they will determine it on is based off of last year's GCI, a percentage of last year's GCI towards next year's, marketing budget, or it's a monthly marketing budget, or it's a per listing marketing budget. We have an amazing, in-house marketing and media team where we provide that value to you guys as well. If you guys need a video done for a launch of a new listing, please reach out to me. Let me know. Happy to, we have an in-house marketing team and media team that, is on salary that will come out and shoot a video for you. I'm going to type into our chat here, our Instagram as well, so you can kind of get a sense of some of the videos we've shot for free for agents that have nothing to do with the buy side of things. It's sometimes like, hey, I'm Joe Smith, I used to be here, I'm now joined Douglas Elliman, or I'm now or it's a launch of a new listing, please take a look at this new listing, welcome. You don't have to talk on the video. It could be just the just the listing itself. It could be something you speaking over the video while not even being in the video. So really, we do it all. I just sent my Instagram, our company's Instagram, and I see that Ronnie Haber asked a question. Jamie mentioned air rights. Is that something you can confirm and also have connections if someone wishes to sell their air rights? We can, to answer the first part of your question, what I can do is you can send me an email. I'll write my email in here again. What I can do is share our services sheet. Our services sheet provides all the different types of searches that we do. We can do air rights, and we can tell you if there are air rights are available. It's a little bit more difficult to tell you where the air rights have been sold to, but we can give you a we can take a look at a lot and be able to give you what we say is our best, our best, uh, assumption. And generally we will disclose that, hey, this is what we believe is going on, this is where we believe the air rights were sold, and etc. But yes, we can excuse me, we can check for air rights for you, and do a zoning search as well. In terms of having connections to someone who wishes to sell their air rights, those are case by case. Do we have people that are, do we work with developers? Absolutely. Do we work? So if it's in a near development site or a potential development site, then yes, we may have, interested parties, but having air rights, without knowing more about the property is just a, I'm not sure. I wouldn't be able to give you an answer if I have, connections for every property's air rights.
All right. Anyone else have anything for Sean? Just seeing if there's anything else here. All right. So this was great, Sean. Very helpful. Just to mention something that I do with Sean. So I have a broker that I work with who has a townhouse listing in Manhattan, and it's a 20, I think it's like a $20+ million listing, and she wanted to do an event there. So I'm going to do, once you bring education into it, it then works where, someone like Sean could come in and participate because it's an educational thing. And so we're doing an event there, and brokers will can get a credit, and we're going to have a little bit, have a discussion, but we'll also have like a cocktail party, etc. And people could come see the townhouse that just got listed. So
Yeah,
thank
it's a
you,
great idea
Sean.
that Jamie offers that for you guys, because the opportunity to have us participate is we can help elevate the listing launch, right? Elevate the event, to make sure that there are more attendees. At the end of the day, you want to do what's best for your sellers by providing the most exposure to their listings. And, the best way to, getting people there is sometimes food and drinks, and then having the ability to add CE credits to that event as well, of course, helps, and more people will likely attend in person. But to mention, Jamie mentioned townhouse, and made me think as well. If you are representing a townhouse that has done construction or any type of work on it, or if you are representing a seller that has a combination unit, please reach out to me, because I'm telling you, there will likely be some issues with title that, once again, may not kill the deal, but will probably delay it. We're now dealing with a deal now where the deal was delayed 6 months for closing, because they had to close out a bunch of permits. There are a lot of banks now in today's world that are more difficult, that aren't lending with open permits. Jamie can tell you, like 10 years ago, a lot of these banks didn't care about open permits. They were closing and lending happily. Banks have gotten more difficult, right? Their boxes have shrunk, and a lot of times there are these wealthy individuals who own a townhouse for 20 years, or own an apartment in one building and then combine it with the second apartment. They pay a contractor, and the contractor collects their fee, and then they don't close out the open permits. Sometimes they do it unintentionally. Sometimes they do it intentionally, right? Sometimes they know, oh, they never asked me to close out the permits. They only asked me to open the permits and do the construction. I did my job. I got paid, and I moved on. And then sometimes you'll see it's difficult to get in touch with the contract. In this particular deal, the contractor passed away during COVID. So the contractor we couldn't even get to them. So you had to have an architect come in, and we had to have it, certified. And it took a long time for this deal to end up finally closing. So just to reiterate, if you have a townhouse that has construction on it in the last however many years, and you have a combination unit that you're representing, reach out to me. Let me take a look to see if there are any issues with the open permits or any violations potentially. So that way you guys can get out ahead of it, try to close these permits out prior to you getting into contract and having to delay. So that's just another good point that Jane made me think of.
All right, fantastic.
All right.
Sean. Thank you so much.
You got it. Pleasure.
And I look forward to seeing you again soon. And thanks for sharing your knowledge with everybody. And
Of
I'm going to have
course.
everybody stay on here as Sean pops off, and we will continue the class now. And
Goodbye.
John,
Thank you.
take care. And Jonathan Miller from Miller Samuels will be joining us at 11 o'clock. And for now, we will just continue with the rest of the class. So just getting into the title aspect, I wanted to touch on a few things that were questions that were asked, and I just wanted to point them out to everybody. So one of the things that somebody asked towards the end was talking about air rights. And I want to be very clear on air rights, because air rights is one of those topics that there's only so much that you're going to be able to do. And it's very difficult for even the title companies, like how much can they possibly do? Now I will say that TitleVest has a program that they did, and I don't know if it's proprietary or not, but what it is, basically, they give you for a set fee, whatever it is, I don't know what it is. Let's say there's an order that you can do for 1,500, there's an order maybe that's like 2,500. And basically you can pick, I think, up to 5 buildings, and then they'll tell you what's happened on those 5 surrounding buildings. I don't think any of the other title companies offer that. And frankly, I think it's great that somebody does. I personally don't see how it's possible, because there's just always so many moving parts. But even so, there's never going to be a guarantee. So how much money do you want to spend investigating it? Once in a while, I'll have a client say to me, I want to know about everything that's being built around here. And is there any chance that my view can be blocked? And I've been very, very firm on expressing to my clients in any circumstance like that, that while today's rules might not allow for somebody building up beyond a certain amount of feet, maybe the air rights were sold and then you can't do anything, I would be very uncomfortable with anybody guaranteeing anything, because there's really nothing guaranteed. There was a very long time that no one thought that the air rights above Grand Central were worth anything either, until SL Green, in exchange for remodeling, refurbishing the entrance to Grand Central on the Vanderbilt side, was now able to build a very high tower. Something that couldn't have been done before. The exception was made. On first, sorry about that. So anyway, we want to just getting back to that. So we just want to make sure that nobody has a false sense of security that you're going to get the definitive answer. However, like Sean said, you can give him a block, a lot that abuts the property, or there's only so many lots that you're going to need to check for your view to be blocked, because it's very unlikely. Look, there's very few places in the city that you're seeing as far as the eyes can go without any interruption, unless of course you're standing in the middle of one of the avenues or cross streets. So that's very unlikely, or you're on the top of one of the tallest buildings on Billionaires Row. But the rules, my point being, even where rights didn't previously exist, there is always a way, especially for the city, to be able to say, hey, you know what? Okay, I know that we weren't allowing this before, but now it can benefit the city. Take, for example, the High Line, right? Well, the High Line, you were never able to build that before, But what they did was they took air rights from a special district. And in this case, it was the special district of the theater district, which is called a special district. And they were able to take those air rights and move those air rights and use them to build the High Line. You know, no different than, I believe that when they were doing that and when they were building the tower by Grand Central, I believe that those air rights were actually taken from the East River, maybe? They were definitely from the east side, though. So the point being that there's only so much that you can tell. What you can do, or you can try to do, is of course you can try and check the addresses of properties located by you just to see if there's any filings of permits, that there might be construction. I don't do this for clients. And the reason why I won't do it is because, you know, anything can happen. I can sit here and say that, you know, if you file on a 50-unit building because you are going to be replacing the plumbing lines, I can say, well, be prepared that it can take, you know, 2 years before everything is done and signed off and the approvals. And then all of a sudden you can have somebody come in there and the next thing you know that they're getting approvals in a month. That's not the norm. And I am always very hesitant. There's too many moving factors when it comes to real estate, when it comes to construction, the Department of Buildings, just everything about it. You know, all of a sudden there can be an earthquake and something can crack and now there has to be different work done. So we just don't know. And it is New York City. There's constantly construction. If your client, you guys know as well as I do, your client finds an apartment that they absolutely love, it could be on a quiet tree-lined street, and all of a sudden something can happen and now major construction is going on at the building next door to you. So I never want, you know, I don't want clients ever to worry about things like that because that can just happen. No different than, you know, worrying about a building that had bed bugs last year. Well, the building can have never had bed bugs. You can go and rent in it, and a month later there can be bed bugs. So you have a snapshot, you know, of what's going on at the time that you're looking at it. And so one of the other things on that note that was not discussed while Sean was on yet was, in addition to running title when a client is purchasing a property. So if it's a townhouse, if it's a single family house, if it's a commercial property, or any form of just residential property that is not a co-op, it is considered real property. And as real property, judgments, liens, fines, parking tickets, environmental control board hearings, all are issues that can attach to a property. It's very easy to attach a judgment to property. Once you have that judgment, you can simply docket it in the county where the property is located. So if it was in New York County, you would go downtown and you would docket it at the county registrar's office. That judgment stays of record for 20 years. It's good for 20 years. So while you may not be able to do anything with it now, it's not going anywhere. Now, one of the benefits of real property is that you own the whole thing. You don't just own an interest in it like you do with a co-op. One of the problems, however, is that almost anything can attach to it and put a mark on title. So now when we order title, the title company, the investigators, the underwriters, they're looking at all of the relevant information as it exists at the time that the order is placed. But they're ensuring it through the date of closing. So prior to the closing, they run what's called a continuation of title to make sure that they get anything that may not have come up because it didn't exist during the first search, so that it exists on the next search. There is a small window of possibility where the continuation is done and there's an intervening factor that happens from the time that the title company has the results of the continuation until the time that the title actually transfers. Keys get handed over, deed gets handed over. Now, all of a sudden, maybe the staging company that the seller didn't pay gets winds of the fact that this deal is closing today. So what are they going to do? They're going to go down and they're going to file a mechanics lien on the property for work that they did because it's a condo. Now, it didn't come up when the examiner checked earlier that morning. Instead, the mechanics lien maybe got recorded at 2 o'clock and the closing started at 1 o'clock. Nobody knows about it. And lo and behold, months later, the owner of the property, or years later, the owner of the property goes to refinance or they go to sell, and now the lien is coming up. And so the title insurance is protecting against that lien that came up and wasn't seen because it wasn't recorded at the time. Now, the title insurance also protects against judgments, liens, transfers, where the paperwork, something was done incorrectly. Take, for example, if let's just say that whoever was doing the filing of, take a mortgage, for example, when a mortgage gets paid off at closing, because that's part of the requirements in order to get title insurance, the mortgage has to be paid off. Now, when the mortgage gets paid off, there's a satisfaction that's going to be prepared and it needs to get recorded too, so that it shows that the loan has been paid off. And lo and behold, it is not uncommon that all of a sudden somebody goes to sell a property and what's showing up on title is that there is an open mortgage. However, the mortgage has already been paid. Now, if for somehow that got missed, nobody picked it up. Somehow, when they were doing one of the searches, they put in the wrong information and it just didn't come up on the search. Maybe there was one number that was different. And now it closes. Well, if something like that happened, and because they looked in the wrong place, or maybe something was filed incorrectly, whatever the mistake is, as long as your client has title insurance, they're going to be protected. So it's a one-time thing. I invest in property. I've never not bought title insurance. It's annoying like all insurances. You know, how much do we spend in insurance? You know, I have, as an attorney, we have malpractice insurance, we have health insurance, we have workers' compensation, general liability, we have to have cyber insurance, errors and omissions. There's so disability. There's so many types of insurance, and it does, you're not always making, filing a claim because of it, but it's just an insurance policy so that you could sleep at night. With title insurance, it's one time. That's it. And once you have the policy, you're then protected. Sorry. I don't even know how to mute my phone. I almost never use that. So anyway, the next thing I just want to cover before we get joined by Jonathan Miller is I wanted to just talk about lien searches, because lien searches also come up a lot. And a lien search is what you're doing to search for any blemishes that can come up when you're dealing with a cooperative. Now, unlike real property, a condo, a townhouse, a multifamily building, a single family home, it's a lot harder to attach to the stock and lease a judgment, to put a lien on stock and lease. It's very difficult. It's not difficult for the federal government or the state to do so. In other words, you're not going to get away with parking ticket, parking violations or Department of Health violations from like the garbage on your sidewalk or an emergency repair lien that was done because the sidewalk had a trip hazard. You're not going to be able to sell any property if there is anything that can attach to the stock and lease. And for the most part, that is only going to be a mortgage, because when a buyer is getting a mortgage, the way that you put a lien on the property isn't the same way that you do with a mortgage with real property. Because with real property, you actually are recording the note. So that's there. You can see it. You can see it on Acris. You can see the documents. With respect to a co-op, what you're going to see instead is called a UCC1, Uniform Commercial Code. Number one is a form. It's that little form. It's also known as a recognition agreement, or I'm sorry, not the recognition agreement, the Aztecs. And the form has to get signed anytime there's a loan, and it gets signed between the co-op signs it, the borrower, who is also the purchaser, and the lender. Everybody has to sign it, so that this way, if the buyer were to default, or if the buyer were to sell, or if the buyer stops paying their maintenance, if the lender or the co-op is to take any action against the shareholder, they must comply with notice requirements of the other party. So it's like a triangle. It's the board, it's the shareholder, and it's the lender. And so that document gets filed. Now what happens is, when the seller who has a mortgage is going to sell a property, now when it gets paid off, there has to be a UCC3 filed. A UCC3 closes out a UCC1. It's one of those problems that does come up a little too often, where the loan was paid off, but the UCC3 was never filed. Generally, we can fix it. It might delay a closing a little bit. And the other thing I want to point out is the very importance of doing things timely. When you have a client that's selling a co-op, remind them to make sure that their lawyer orders what are called the collaterals. The stock certificate and the proprietary lease in all co-ops where there is financing, the original documents, the ones with the raised seal that the co-op provides and needs back at closing, get held by the lender. So the lender sends their attorney to closing with the original stock and lease, the one with the raised seal, to give it back, so that it goes back to the board at closing. And then, and if it's lost, what you can do on a co-op is, there's something called it's a leasehold insurance policy. Generally speaking, the most common one is the leasehold insurance policy that a board might require where a seller does not have their original stock and lease. And so the purpose of the insurance policy is to make certain that, and this is, you have the title insurance that somebody buys. This is a different insurance that most people do not get with a co-op. It's only if there's a reason or a need, like, for example, the stock and lease are lost. The vast majority of co-ops and management companies in New York, where the stock and or lease are lost, will require a seller to pay for what's called an Eagle 9 insurance policy. It's actually a policy that I believe it's only provided for through First American. And I guess that's Title Vest because Title Vest bought First American, so you could buy the policy from either one of them. I think that other companies offer leasehold policies, but frankly, I don't even know that they care about issuing those. It's not like there's not a ton of money in those, so I don't think really, you might be better off just staying with the master of it and whose policy it is. You might also purchase an Eagle Line insurance policy when the property is purchased out of auction, foreclosure, a short sale. Um, if it's a very, if it's a very high-end property and there's any question of anything just worth doing. But otherwise, generally speaking, there's not insurance on lien searches. I think that on our lien searches, there maybe is like 50,000 or 100,000 of insurance, but generally speaking, no one's guaranteeing anything. A lien search is really for informational purposes only. So I mean, most title companies will say that they never even had a lawsuit on a lien search. It's the real property where there's an issue. So we're going to take 2-3 minutes. Jonathan will be on in a couple of minutes. I'm going to grab some coffee. Whoever needs to go take a break for a minute, and we're going to hop back on here in 4 minutes. I'll see you then. Okay, we'll get started here in a couple of minutes here. If everybody can just sign back in on the chat. Oh, hi, Jonathan.
Hi,
How are you?
good. How are you?
I'm doing great. Oh, it's so nice to see you.
Likewise,
Yeah, it's how's everything going out there?
living the dream.
Yeah,
So no, it's an interesting time.
sure
A lot of
is. Especially in the
uncertainty.
last 24 hours even.
Yeah, yeah. It's just a never-ending adventure to try to find clarity in what's actually going on and what will impact the housing market, right?
Right, definitely. I mean, on the one hand, there's nothing on the market. On the other hand, rates, I will say, I have a client that just is about to close. I think we're closing next week. She just signed her commitment, 5%.
Yeah, yeah.
And she
No,
paid a point,
yeah,
but it's still 5%, and it's a 7/6. So it's a 7 year. It adjusts every 6 months after 7 years. But as Jonathan will
yeah.
probably tell you, the average loan that people hold is not more than 7 years. So
Right. Right. And also, mortgage rates, the 30-year has since August 1st has come down over 50 basis points. And so we're starting to see the uptick in activity nationally. Pending home sales data was up this month or last month. There's just more churn, more activity as, the lower rates go, the more people, sort of fall into the market. And that's what's missing from this market is normal activity levels.
right. Now, so there's greater volume, but lower prices, right?
Uh, it depends. So in the outlying suburbs of New York City, bidding wars still, and this is as of the second quarter, bidding wars still, depending on the local market, and I'm talking about primarily Westchester, Fairfield, and Nassau, Suffolk. Um, you're really talking about bidding war market share of about a third to as much as half of all the transactions are selling above the last asking price. So it still shows you how tight it is. And actually, over the last couple of months, there's been a lot of discussion about inventory rising. And yes, inventory is rising, but it's different across different regions. So in the Northeast, inventory actually has stopped rising, or we're not seeing the new inventory come on very much. Where it's really prevalent is the Sun Belt, Texas and Florida, where there's been a tremendous amount of inventory that's come in because their markets, they can build faster. And uh, for whatever reason, there was sort of this overreaction to the migration of people moving from, say, California and New York City or the Northeast to go south during the pandemic. They responded much more quickly. So as a result, inventory is very different. It's low in the Northeast, low in the Midwest, moderate in the West, and high in the Sun Belt states. It's very different. In fact, that's the most, when you're thinking about valuing property or the direction of the market, inventory is the most important metric in housing today, in my mind, more than price direction, even more than sales, is the supply on the market.
What? Okay, let's elaborate on that a little bit.
Yeah, so when I think of when you think about the value of a property, you're thinking about, what is somebody going to buy it today and think they're going to, be able to sell it tomorrow for. And and the last thing, but the consumer always looks at first, is price direction. Are prices rising, prices falling? But to date myself, and I probably say this every time I'm on here, is that prices are the caboose at the end of the train if trains still had cabooses. It's just it's after the dust settles, that's price, but really transactions lead the way, sales and inventory. If sales are rising and inventory is falling, you know prices are going to go up. What's so different about this coming out of the pandemic era is that prices really didn't adjust in the same way you'd expect with mortgage rates more than doubling, right? It didn't, and that's the lock-in effect. That's, if I bought a house at 3.5%, do I really want to put my house on the market and become a buyer at 6.25% or 6.5%? Probably not. And unless I'm sort of forced to, job relocation across the country, just had triplets, whatever. And so now we have this sort of market where we have low sales because are not low, but lower than normal because interest rates are much higher and and we have a lot of uncertainty right now. I could spend my whole time here talking about the insanity of tariff policy and how that has actually is the reason why we're having lower mortgage rates. Because that's a tax on the consumer. And the second they were implemented, we saw a lot of a large loss in jobs. Try to be a college student now, graduating and get a job. It's much harder now than it typically would be. Not all sectors, unemployment is still low, but there's a lot of cracks forming, and that's the reason why the Fed cut rates. So in a weird way, the insanity of tariffs has really helped or is helping the housing market right now.
Uh, what do you think I can't help but think that obviously everything relates to everything, but you have right now somebody like myself, right? Two
Yeah.
and a half percent we have.
Yeah.
And
You're not moving,
right.
probably.
Well, yeah. Well, here's
Well,
the thing. Here's the thing that's going to happen to me, though. And I do wonder, I think that regardless of where you live or how, what price point the house is in, I do think that there are probably a lot of people like me that there's of course, who gives up 2.5%. But then again, there's a certain percentage of us out there that are at that 2.5% or the 2.75 or the 3,
yeah,
and we're also entering an empty nest stage.
yeah.
And so when you get hit with that, so for me, this is like it's a process.
Right, right. Well, I think the way to think of it, the way I think of it is, uh, the, when someone like yourself that has, a crazy low mortgage rate relative to today. And by the way, do you know what the 50-year average is for the 7% or we're locking 6.5, 6.3 as a 30-year fix. You know what the 50-year average is for the 30-year?
I'm
Eight,
guessing
just
6 or 5. I don't know.
eight. It's
Oh,
like
wow.
7.9 or 7.8.
Wow.
It's just under eight. That's the average over 50 years. So I always correct people when they say high mortgage rates. I use the word elevated because they're high relative to 5 years ago, but they're not high historically. Another way to think of it. Um, but the way I think of your scenario, I became an empty nester about 3 years ago, and we downsized by half, the size, but we got twice as much land and a pool and all that. Um, is that all that happens is the lower the rate, the lower the probability of an immediate move.
Yeah.
It doesn't mean that people won't move. It just the lock-in effect just reduces the probability. The thing is, as much as we fight it, life moves on without you. That people do make moves. But what it ended up doing was delaying the move.
For
And
sure.
you know, and so, ultimately, someone like yourself, there'll be other things you consider in the economy or your job or your outlook on life that'll change your thinking enough for you to make the move. But if you became an empty nester yesterday and mortgage rates are 3%, you'd already have your house on the market, right? I mean, it just delays what could be done much more quickly or an easier decision with lower rates.
Well, one of the problems, I think, and it was certainly the problem for me, which I'm not out of yet, was wrapping my head around the idea of selling, because we are in a very big house with the pool and everything.
Yeah,
But we still have the three dogs, we still have the kids, we still have one in
right.
high school, we still have all these things. But the biggest problem, forget all of that. That I can deal with, was where was I going? Where am I going?
Yeah, where are you going? Right. And so the appreciation, the value of your house is sort of money on paper at this moment because, you have something you're used to, it serves you well and all that. Um, I had uh, we downsized 3 years ago to a house that's literally 50% as big, but it's just my wife and I had 4 kids and all are gainfully employed. All have been, engaged or married, we have 4 grandkids. We just didn't need that space.
Right,
We
of
don't have
course.
any dogs or we had cats, but no longer. And so we made the move, but we made the move. We wanted to make the move so bad 3 years ago that we won a 30-way bidding war because uh, because mortgage rates were insanely low and there was no inventory because of the lock-in effect, or not lock-in effect, but just the idea that things are selling so quickly, faster than inventory could come on the market, that we ended up being in a 30-way bidding war and won. Um, and we overpaid by, being an appraiser, kind of is counter to what I stand for, but we were 36% above the asking price. And but by my math, they listed the price way too low, and we only overpaid, only in air quotes, by about 15%. But if you believe like Realtor.com and Zillow, and pricing and all that, we're about 20% above what we paid, right? Because we knew the supply was a long-term challenge going to be, even if rates went up, and it has been, that we knew that that being an outlier in price back then was not crazy, even though, so that's why I sort of brag about it, like in a sort of irresponsible way. But the way to think of, and and what I did is just what we talked about, is thought about inventory is not going to pile back in, and the only way it would happen very quickly is if rates plummeted from 7 to 2.5 or some crazy number. Then we'd have a stampede of inventory. But that's been unlikely.
You don't think that the mayoral election could lead to inventory?
So I just uh, a an international developer just asked me to write sort of a piece on risk, on risk to developers, and one of them was the New York City election. Others were like interest rate risk, geopolitical risk, that sort of thing. And after really going through it, I think the risk to the housing market in New York City with a new mayor is moderate. It's not high. And the reason I think that is because what is said on the campaign versus the institutions in place and the elected leaders in place, and knowing that over 50% of New York City's tax revenue comes from real estate related things, um, that I think there's been an overreaction to that. I'm not saying it won't have an impact, but there's clearly been, in my mind, an overreaction. Um, uh, and we'll see. We don't really know. That's the uncertainty. One thing that you'll find when you listen to me is I use the word uncertainty a lot, and just to be clear on that, there's always uncertainty, no matter how positive or negative the world is at that given moment. It's when it starts getting really high or really low is when you start to take notice, and it's been really high. And so it's more, the risk right now is more about the lack of clarity, understanding. And I bring that up with the tariffs because two countries can negotiate, they agree on a percentage, and then next day the policy is reversed or changed or doubled or tripled, right? So there's a randomness to economic policy that's based on a misunderstanding of what tariffs actually are. And I look at that as a higher risk to New York City and every location in America, farmers in Tennessee, much more than this mayoral risk. I hope I'm right.
Yeah, no, I hope you are too. I definitely have been hearing from people. There are people that swear they'll move out.
Right. There's a lot of people that said during the last election that they'd move to Canada, if a certain candidate won. Like, there's a lot of things that are said on the moment and then they're amplified on social media, but they end up not really happening.
Right.
So I don't disagree that there's that chatter out there for sure. Everybody's heard it. The question is whether there's an actionable event. And at least at this point, there's no real evidence of some sort of fleeing the city narrative. And we'll see.
What are you seeing on the rental side of things?
Uh, so the rental side, so when you think about what 2025 was a very unusual rental market in that we are having, and specific to Manhattan, but universally across the five boroughs, rents have been rising a lot this year and have been in Manhattan in the last 8 months. So through the end of August, 5 of the 8 months have been the highest in history. The median rent was the highest ever tracked. And 3 of the months were the second or third highest in history by like $5. So and what was unusual about 2025 was that rents started soaring upwards in the beginning of the year in the winter. And that's really unusual. It's usually July and August are peak leasing seasons. That's where rent tends to be the highest. Everybody wants to get in before Labor Day. And July, as it turned out, was the peak of the year. And now with mortgage rates trending lower or down a bit from their 2 month ago highs, I'm anticipating a pullback in the fall of rents. So instead of being at record levels, they're just going to be high.
Right.
Not this sort of rocket ship upper progression that we've been seeing. And I think that's going to be a pretty reliable way to think about it, unless mortgage rates spike or something crazy happens. You have to think about they're not polar opposites, but the rental market and the purchase market, uh, the reason why rents have been so high is because you've had people waiting on the sidelines to buy. They've been, I call it camping out in the rental market. And I think with rates falling, I think there's a tremendous pent-up demand level in New York City to buy. I'm not saying it's going to be the biggest housing boom of the modern era, but if Fannie Mae just forecast mortgage rates over the next year to trend a little bit lower, and by 1 year from now, they're talking about like 5.9%. which my sort of wild guess is that when we hit a 6 threshold, there's going to be a mini housing boom. It's a symbolic sort of threshold. It may even happen before that with anticipation. Now, here's what we're seeing on the ground on the purchase market, and I think is very logical, is that there are two more Fed cuts being forecast by Wall Street. At the minimum, one more cut. The Fed has basically said, sort of confirmed that there's going to be more cuts by the end of the year. So the question is whether or not mortgage rates will actually fall. Because, just to point out for those who don't keep track, a year ago in September, when mortgage rates were cut by the Fed, not mortgage rates, interest rates were cut by the Fed by 50 basis points, mortgage rates went up a full percent the next month. So there's not a direct correlation, but it does influence the direction of mortgage rates eventually. So if the damage to the economy from the tariffs accelerates, then we will see mortgage rates continue to fall. And if we see mortgage rates continue to fall, or slip is probably a more appropriate description, I think we're going to have a very robust fall market with more transactions. And when I sort of describe it as getting back to zero, that it's not that we're going to have an extraordinary level of sales, but I think we'll have a more normal level of sales for a fall market. When you think of housing, it's a two-hump camel is the way I describe it. You have spring and fall, with the spring being the bigger hump, but fall being sort of a significant hump. And I think we're gonna, the last two spring markets have been very underwhelming. And so I think we're gonna have based on, if things continue as we expect, then we could definitely see a more normal transaction market. Into the real estate brokerage or agents out there, that's, it's all about transactions. It's really not about prices. Uh, and transaction volume might normalize. So at least, for in the short term, I think rates will be, drift lower most of next year. A lot's going to depend on whether the tariff policy, the Supreme Court upholds what the appeals court found was that they were unconstitutional.
That they were unconstitutional.
Yeah, that's Congress, Congress's responsibility, and it's not the president's. And the reason why the founding, or why this is, in the Constitution, is so that we don't have what's happened now, where you have one person on a whim, sort of picking, well, I don't like them. Let's raise the rates, or let's lower the rates. And it's based on a sort of a false understanding of what tariffs are. So, for example, if you go to the grocery store and spend $200 on groceries, and you come home with the groceries, the grocery store has your money, you now have a $200 trade deficit with the grocery store. And that's all it is accounting. It's bizarre, right? And that's literally what it is. So all the revenue coming in for the tariffs is excess costs paid by mostly the American consumer, which is crazy.
But isn't it, I'm just playing devil's advocate for a second. The US is taxed on everything that goes out of our country into another country.
Right.
Always. We pay tariffs across the board.
Yep.
It stands to reason that it should be the same way.
Yeah. So what you do if both sides, so there's retaliatory tariffs, right? So what happens is both sides end up paying a lot more, and that gets passed off to the consumer in both countries. So it's counterproductive. Um, our average tariff rate across the world before the tariff policy was about 1%. Now it's 18%.
Oh, wow.
And the other way to think of it, I have a son, one of my four boys is in sort of he works for a like a luxury goods manufacturer, like, furnishing in that sort of category. And when he buys one of those containers, they're on the container ships uh, of fabric from China, it's about $400,000. That's what they cost. With the tariffs, it's another 250,000. And so what is his company going to do? They're going to
Charge
offload that
more.
cost into their prices. That's what they're doing. So that 400 costs 650 now, right? That's it. Like there's this fantasy that the 250 tariff is paid by the exporter out of China. It's not true. It's paid by the
Right.
importer here, and then the importer passes it along to the consumer. They're not going to pass 100% on, but they're going to pass the majority of it. Goldman Sachs just came out with a study that consumers are paying about 80% so far, but it's rising of that increased tax. So now you have this world where you have all this random costs being added under the guise of a different person's paying it. I mean, just look at grocery prices. My goodness. You look at meat is up like 18%. Like why, right? It's because of tariffs. And so if that gets,
But don't
normalized,
you think food has been so much more expensive way before tariffs?
yes. Yes, it has. It has continued to expand.
Yep.
Um, but it has in the last year, the last 12 months, year over year, it's expanded much more than it has in the past, in the last, past 4 or 5 years. And that's being attributed to the tariffs coming, tariffs on Mexico, tariffs on Canada, our trading partners and allies. And it's all based on a basic misunderstanding of what a tariff is. Um, so, and so that's the economic uncertainty, and it's being translated into significant job loss. And as a result, we will, the Fed is sort of caught between a rock and a hard place because, and this is why, because if you think of inflation you remember, a year and a half ago where we had like 9% inflation. And so we had inflation based on prices, right? Prices were higher. And so employers that were getting, were seeing this inflation, they could afford to pay more wages to keep employees. Now, the inflation is more cost oriented and the prices are the same. So there's more pressure. And that's why we're having layoffs and,
Well, that's
we're having sort of, this general weakness in the economy right now. Just
well,
go to Disney World or go to Las Vegas right now. Tourism
right.
is down like, 8, 9% from the sort of state of the economy.
Well, I think that from where I sit personally, and I say this, I've been saying this a lot lately, it's not enough to produce as much as you did last year anymore.
Right.
Because if you're only going to produce that much, you're going to have to
It
cut
costs more to live.
somewhere because you're not going to have as much money to live on. You're just not.
Right.
Everything. I mean, there is not one part that has not risen. It's ridiculous.
Yeah. Anything related to home ownership, real estate taxes,
Traveling, anything,
insurance. Yeah.
entertainment, everything is just so expensive.
So disposable income, has reduced. It's interesting at the same time that that's happening, people have more home equity in their homes than at any time in history, right? Um, but you're not seeing like a home equity boom like we had, during the housing bubble or before the housing bubble, where people are buying boats and they're going, because they're concerned.
Those
There's
were
more
the crazy
concern.
days we all lived.
Yes, it was crazy, right?
Table service, like the crazy table service. And yes, I'm
Yeah,
sure it still goes on to some extent,
yeah.
but not not what we did 20, 30 years ago.
No, it was a simpler time, I like to say. But anyway, so it's interesting. So you think about, as a real estate agent, you're thinking about you're dealing with people that are more than less are dealing with sort of economic challenges in their own mind. And the part that I find really interesting, in the context of real estate sales, is you've got um, this idea that when you've got, I'm trying to think how to describe it. You've got people that uh, we've got a housing, so we've got like, there aren't long lines at employment, of unemployment. Unemployment numbers are low, but you have people more worried about their job. You have this sort of baked in like fear, or, like the nexus between fear and greed is more about fear. Greed was like what you were talking with the table service, like, just, have at it. And so people are being more conservative now about their financial decisions. When I think about um, people waiting for like 3.5, 4 years for rates to fall and being really, well, when mortgage rates fall, and mortgage rates just fell, 50 plus basis points, 0.5%, then I'll buy, right?
Right.
And but now it's like, then I'll wait till the next rate cut because then they'll be lower. The problem with delaying, and I'm not selling here. I'm not selling. I don't sell houses for a living or anything.
Right.
But the problem with waiting is that housing prices a year from now, 6 months from now, as a general comment, will be either the same or a little bit higher. Now,
Right.
that's a market-wide look, individual, yeah, some prices are lower than, sort of a peak period or whatever. But just in aggregate, when you look at like at a county level or a city level, prices a year from now will be higher than they are now. And part of that is in good chunk of the country, like 2/3, 3/4 of the country. So then you think, well, but rates will be lower. Yeah, but the you're waiting for a lower interest rate and your asset price is rising. It's like
Right.
counterproductive. Uh, in many ways, and that's what we're seeing, like in the national jump in pending home sales, is you're seeing, activity pop in August, and it popped because rates fell. And they're doing that because prices will be higher. Um, Maybe not a lot higher. The rate of growth is diminishing, but waiting for rates to fall. What we learned during the pandemic is that when mortgage rates are too low for too long, housing is less affordable.
Yep.
And when a buyer is looking at the direction of rates, guess what? The sellers are getting the same memo, right?
Yep.
And so they're thinking, well, I can be less negotiable. Maybe they won't raise their list price, but I can be tighter or tougher on the buyer who might be trying to lowball me. Um, and I think that's what's going to change with these next two rate cuts. So instead of waiting, I think in many ways, I think that's foolish if you're ready to go. Um, I'm not a big believer in timing markets based on interest rates.
Huh.
Um, anyway, just food for thought. I
Right.
think that's something to consider.
Well, the other thing is that just like you were saying, if rates go down, more people are buying. But like
Mhm.
you said, prices are going to go up because the competition then is there.
Right.
The only thing, and I don't know if you have these statistics, is there's also, I believe, there's always at any given point in time, there's certain generations that are at that stage of making a move, right?
Yeah.
So kind of getting back to the downsizing thing. So, you know, and it's, and like you said, you know, you made a calculated decision. You did over ask, and look, lo and behold, the house is worth more anyway. Same thing happened. Look, we bought our house in 2012, and
Yeah.
we, you know, it's like, okay, we paid more than we wanted to, but it's going to sell for double, you
Yeah.
know? So it's like,
Yeah. It depends, you know, like I think a lot of people, a lot of buyers, when they buy, they look at it as like a flip. Like, hey, if
mhm,
I have to sell in 2 years, but it's usually a longer term play.
yep,
Depending on what sources you read, you know, the average holding time is 7 to 10 years. You know, that it varies by market. The long-term rule of thumb was 7, but it's really 7 to 10 as the average, right? And you know, a lot happens in a decade, I can assure you, having
yep,
lived through many decades. Um, but the other thing is that um, uh, if you think that so as the economy is starting to break right now, and that's why we had rate cuts. But what the inflationary pressures we're seeing are kind of like slowing or making the rate cuts slower than they probably could have been. Um, but there is a downward trend in where rates are going, not for the next 3 months, but for the next couple of years. And it doesn't mean that they're going to correct or go. I think the days of, you know, in the fours or threes, like that's, I don't want to say maybe once in a lifetime, but that's not normal. That's crazy,
well,
right?
it
And
ended up in putting us in the situation that we're in.
well, we're in this
Not,
period of
not, no
distortion.
interest, no, right, no,
Right, right. It's a distortion period that we're still in because rates are too low for too long.
yep,
And the other thing to think about and why I'm so enamored with inventory as a metric is that inventory is this um, sort of, how to say it, it's like this sort of thing, this glowing, living, breathing blob that that evolves and grows over time. And it doesn't respond quickly, you know, unless there's a massive change in interest rates. It just sort of there. And so what happened during the pandemic is rates were too low for too long, and they were wiped off. The inventory was largely wiped off the face of the earth.
yep,
And so we kind of had to start over. And but rates, you know, rose in the last 3.5 years at their mortgage rates rose at their highest ascent in history. And that caused people not to put their house on the market because they've got a 3 year, 30 year. And so that blob sort of stayed the same size. And so I want mortgage rates to be, I think, normal level of mortgage rates. And, you know, honestly, who knows? But my gut is that normal is like 5.75, just under 6. Long term, maybe it's 6. But like the idea of going below that again wipes out supply, and creates more distortion.
yep.
So, you know, so that's sort of here we are. Like, we should learn from our past, and low mortgage rates make housing less affordable. Uh, because they impact you in the short term. Like you're looking to make an offer and rates just drop and you're like, okay, I can go that little extra. And maybe the seller doesn't really process it yet. But 6 months from now, and you know, mortgage rates are still at that same level, it's all baked in, right? And so why are you waiting? Because it's gonna be a more expensive house for you as a buyer.
Jonathan, let me ask you this. What about, what impact do you think, well, I shouldn't say it that way. Why haven't we seen a massive impact on the 5 to 7 year arms that people were taking in like 2019? I mean, there was a lot of them. And
Yeah.
I would have imagined, if I would have predicted, I would have said there should be a ton of inventory coming on, because how are people that have
Yeah,
threes?
how they refi.
Yeah, right. So how, I'm just surprised.
So what they
Or is
did is
that the inventory that we are seeing?
they refied at a higher rate because they didn't want to move. Um, and it just sort of it, I don't have a great explanation where I think of uh when my youngest son moved to Manhattan, uh, and he and all his friends from high school, they graduated college, they all moved into the city. It's like my hometown got moved to like Midtown Manhattan, and they all, went in when rents were really low during the pandemic, and then rents have gone through the roof, and they're they're all staying. It comes out of their disposable income, but they're all staying. And I think there's been maybe a little bit of part of this, and to your question, is that wages today are higher than
Yes,
pre-pandemic.
yes.
And they're not as high as they were, 3 years ago, but they're still a lot higher than pre-pandemic. And that has enabled them to, my theory is that it's enabled them to eat that higher reset on the refi.
Yep.
Um, and that's what's also different about this is that we haven't seen the same duress individually, because A, everybody's got a ton of home equity, and B, wages are higher. It just doesn't feel as high because inflation or
Correct. And
higher costs have been high.
the cost of living is so
Right,
much higher.
right. So I'm not, sort of being cavalier about like it's not, think costs aren't higher, but part of the what has helped sort of manage that has been higher wages in general. And
And tons of people picking up additional income by way
yeah,
of
yeah,
just
right.
social media and just anything, remote working. There's so
Yeah,
many extra
there's been a lot
ways.
of that. Well, it's
Yep,
funny because you say remote working because that really had an impact on the housing market, right? You had, people could then, hey, live where they want to live
that's
because
right.
they only had to commute 1 or 2 days a week. And now there's been this whole move, RTO, return to office, in the press, a lot of discussion about that, and versus work from home. And I kind of laugh about it because, like, one of the things in publishing market research and anything you read, on the internet about the housing market, the source is what matters, right?
Right.
Like, are you getting info from someone who's shilling, that it's a great time to buy, or is it like, logical and, and so all the big sources that are saying RTO, we're issuing this, blah, blah, blah. Um, Most of those have an interest in the commercial office market. They have billions, JP Morgan Chase, Jamie Dimon saying, RTO, and, maybe not 5 days a week, but, close as we can to it and all that. Well, they have billions in mortgages on commercial office buildings. They're
Oh,
a
yeah.
tainted source of information.
Yep.
And so you should take that with a grain of salt. Like that's not a compelling reason. And so it has not been this sort of blowout change and people are moving back to the office. My analogy, which is not based on any fact, is, or the numbers aren't based on anything, any research. I sort of think it, when they do this, and you're going to have this ebb and flow where people work from home an average of 3 days uh, a week. Wall Street wants 5 days. Bloomberg News is 5 days,
Oh,
right? So
wow.
so you have across different industries because they've invested billions in offices. They
Right.
have 20 years left on their lease. They want their employees using it, right?
Right.
And so you think about that, and like as you're trying to understand the housing market, all that matters is the source where you're getting it from. And the whole RTO thing, like to me, that cat's out of the bag, the toothpaste is out of the tube, like that's never changing, but it's going to ebb and flow. It's going to ebb, I'm making this
Right,
up, from 3.1 days a week to 3.8 days a week, right?
right,
And then back to 3.2, like that's what it's going to be. And you're going to have some industries that are going to be more inclined. And part of that too, think of, the average age of a Wall Street CEO that's dictating this, right? They're in their 60s. They're going
right,
to be retired in, 5, 10 years. And the next generation that grew up on work from home. So it's, that's how you should think about the housing market is like, think about the sources, think about, what your buyers say and where they're getting the information, and a lot of times it's not credible.
right. Jonathan, let me ask you, we only have a few minutes left anyway, but what are you seeing in terms of appraisals?
Mhm.
How has the actual, what's going on in terms of transactions and volume and pricing,
Yeah.
how has it impacted the appraisals?
Well, what we're starting to see now, so this has been a really quiet, slow couple of years for us in Manhattan. That's Miller Samuel is basically about a third of our business is sales related, sales and refi, call it interest rate related.
Right,
And it's been pretty slow because rates have been stuck at elevated levels. I can tell you in the last couple of months, we're seeing a lot more transactions and we're seeing a lot more refis. There's sort of a mini refi boom going on. And so, and we're seeing that, the brokers are seeing that in Manhattan as well. There is definitely an uptick. Um, our other business, which two-thirds of it is sort of legal support, like estate and trust and matrimonial, just general litigation is, just been, it seems, I don't want to say inflation proof or recession proof, but the variable in our business has been transactional. And it's been very weak until the last couple of months, which has been nice to see. Um, the other thing I'll say is that banks, if you look at sort of an historic timeline of being sort of conservative on underwriting or not, they're far more conservative than the long term, but they're less conservative than they were a year ago, is the way I think of it. So they're still erring on the side of caution, but not as insanely as they were, just given a year ago, I'd
no,
say.
definitely not. I mean, I'm in contract, on a property that's an investment property, and me and my partner took a mortgage at 6.75%, which is not bad at all on an investment.
Yeah,
And that was, I mean, it may even be, I think we already locked in, but either way, the one thing I'll say where people are like on the fence of what to do, most of the banks, not all, some, if there might be a prepayment penalty on some of them, but most of them, there's not. Most of them, you may have to wait a year, but if you went and you got a mortgage right now at 6%, and whether you pay a point for it or not, but you could then bring it down a point come next year, refinance then.
right, right.
Because if your theory holds true, which in my opinion, and I've been watching the markets and been involved in them for 30 years now, it does always go up.
Yeah,
It's gonna go up as long as you can wait.
right,
Wait out the punches, whatever those might be.
right.
And so it doesn't, so if that's gonna be the case, then why wait because of the 0.5% when, like you said, your property is
Prices will
probably
be higher.
20% more.
Yeah,
You're making it up on the increased value by having, overpaid 3 years ago.
right, right. That's yeah. It just depends when you're buying. Is the purchaser have a short window, medium window, or long window? Like, what is their plan? Plans change, but most people when they buy a house, it's the biggest transaction of their life, and it's a longer term, 7 to 10 years at a minimum,
Right.
probably. Or that's the average, but I certainly know, it's anecdotal, but it seems like all my peers have been in houses for 10 years or more. Um, and the idea of, buying something for 3 years and flipping it or whatever, like that's not this
Exhausting.
world.
Right.
That was another time. Oh,
Yeah.
by the way, just as a sidebar, sort of unrelated, but most of the reality shows that are flipping shows, they're all in Canada.
Huh.
Almost every one. There's a few that aren't, but most of them are. And the reason is that they didn't have the big correction after our Lehman moment back during the bubble. They just kept going higher. I mean, they're in rough condition right now too, but their prices have continued to rise, and ours have been much more volatile. So,
Well, yeah, and there's those companies out there that were going and buying all of these homes, thinking that they knew something different than we knew, and
right,
taking baths.
right, right. So it's uh, there's a lot of information out there. Just care about the source where it's coming from. That's the most important thing.
All right. Jonathan, it's so great having you on. It was so great to see you.
Yeah, likewise.
In the 5 minutes we have, if you could answer this question, what impact will the Compass Anywhere deal, where do you see it impacting the brokerage market the most in terms of what's going to change? What do you predict to be the biggest thing we're going to see?
Uh, I first of all, I wrote a huge piece on this the other day.
Okay.
I have a website called Housing Notes, and I wrote about the Anywhere Compass transaction. So the ultimate long term, based on what Compass has said, is going to be reduced fee splits for brokers. So,
Ah,
and the reason for that is because because now if and it's still a question mark. Since I wrote the piece on Monday, I'm more, I've sort of learned more about the odds of regulatory approval, and the odds are falling of approval. They're still high, but they're falling. And that's like a 5 hour discussion I won't bore you with. But the reason I think fee splits are going to fall for real estate agents with this merger is because of what they've said, which is that they're trying to reduce dependency on the agents. So as they grow, right now when the merger's approved, they're going to be 3 times larger in gross commissions than the second place, the new second place, which will be eXp Realty. And so all those brands, I don't know whether they're going to keep, as they say, they're going to keep the brands or not. But I think the first thing they're going to do is the day they're approved, they're going to cut off all the feeds to Zillow and Realtor.com. They're going to go double down on private listings so that they can double dip on the commissions and basically not inform the buyer. There's going to be a lot of litigation by consumers against agents who didn't know that only 3 people saw their listing, or the buyer didn't know that the listing was on the market for 18 months. And all those things factor into price discovery. How do you think about what you're going to pay for a property? Ultimately, you're going to reduce competition, and that's going to, typically what happens, if a broker's or an agent work with a firm and they're getting X%, one of the primary reasons they go is because they're going to another firm because they're going to get X plus 5%. They're going to get a higher split. A lot of those firms are, there's going to be a sort of a culling of the herd of the remaining firms. And I do think this is because the only way, Compass has barely been able to make a profit. Just in recently, it's been very thin. And the only way in my opinion, based on public information, is that the only way they can really make money in the long term, be a viable entity. Remember, if I gave you $2 billion in capital, Jamie, I think you could start a national real estate company too, right? I mean, uh, uh, like it's an insane, they're disrupted by capital. And what they have to do is be a viable concern. And the way it's commissions that the split. Um, and I think it's going to promote a rise more boutique sort of mid-sized firms that will compete and offer the services that the IMF probably can't. That's my 50-cent overview.
All right, sounds good. Well, we appreciate that, Jonathan. Great to see you, and thank you so much for
My
your
pleasure.
information. All right, and
You bet. Nice
all
talking to
right,
you.
and
Take
hopefully
care.
see you again soon. Thanks,
You
Jonathan.
bet.
All right, if everybody could sign out here on the chat for me, that would be fantastic. Great information from Jonathan Miller, always. Love having him on. This was a good one. I hope you guys enjoyed it as much as I did. Gave us a little bit more than just the legalese, got real updates on what's going on here. So anyway, sign out here on the chat if you can, please. And with that, anybody wants to pick up a class tomorrow, I am holding another class tomorrow. And I believe that one is at 12 o'clock, I believe. And with that, have a great rest of your day. Stay dry, and I'll see you next time.